In this session, we're going to try and basically look at how do you go about building a valuation model for a company from scratch. In our understanding, we'll pick up the company called Maruti Suzuki, and we will basically be trying to build it up from ground up in terms of an Excel file and modeling exercise. To understand what all goes into a valuation model, we'll take a step back and try and understand a little bit about the company, a little bit about the sector, and then we move into the actual nitty-gritties of looking at how do you sort of build that model in terms of the drivers. So all of us predominantly know that Maruti is the largest passenger vehicle maker in India, and predominantly strong at the entry level vehicles category that is there, the hatchbacks and the sort of sedans that are there. That's where they have their bread and butter sort of coming. The compact cars is what Maruti has been predominantly strong with. Maruti's market share in India is about 50% of all passenger vehicles that are sold approximately, right? It's moved up and down a little bit. Just to give a little bit of history around Maruti, roughly in the years early 2000s, basically this market share used to be beyond 60% because they were the only player then. And then, a lot of other competition kind of walked into India in that space. What is remarkable is despite so many new models and competition coming into that entry segment, the compact car segment, essentially, Maruti was always able to manage A, the costs, B, their market share, never necessarily going this is below the component of 50% in terms of the market share, right? So that's been one of the predominant factors why this has been a segment that has been sort of covered, and a lot of the people have really liked this as a company, and understood this as a company and looked at it in that context. It's also played a lot in terms of the understanding of what the Indian consumer wants, what will the Indian consumer pay for, and consequently coming up with products in that context, right? That's been the sort of backdrop and history of Maruti. To also understand a little bit about Maruti, it's important to understand the passenger vehicle landscape of India. So if you look at the passenger vehicle landscape, you can break it down into sort of multiple components and kind of cars that are there. You will have the hatchbacks, which are available, which are the ones which your, sort of Santro and Wagoner and the initial Swift, Alto, all of those would go into that. You'll have the sedans, where you'll have the Swift Desires and Honda Cities and all of those coming into it. You have the SUVs, which are essentially your sports utility vehicles. And then you have the MUVs, which are the multi-purpose utility vehicle or multi-utility vehicle. Some of these are also used in industrial segments, the MUVs specifically. But MUVs would be, either cargo carriers or big passenger carriers, where you would specifically classify them. SUVs are more, the conventional definition of SUV is something that is going to be used for a little bit adventure and, sort of off-roading and all those activities that are there. There are also crossovers, which are basically smaller cars, but they're moving into that domain of what is predominantly known as SUVs. So we'll treat them for our purpose as SUVs, cars that are basically moving in that segment. Now, historically, because of variety of reasons, the fact that we were predominantly an emerging market, we were kind of growing up, the predominant focus categories in India were hatchbacks and sedans, right? Ease of use, smaller spaces, predominant usage being within the city. So we would have all grown up seeing the bunch of cars that are sold around us predominantly being hatchbacks and sedans. Over the past decade and a half, what has happened is connectivity has improved, infrastructure has improved, road connectivity has become super, connecting cities. So people have started basically moving around intercity as well, which was predominantly intracity. And because of that, the demand for SUVs and MUVs has basically started spiking in the past few years predominantly, right? There's a trend around that, and that's been how the market has shaped up. All these years, till the time the market was focused on the hatchback and sedan segment, Maruti had a near stronghold of that segment because they understood that piece. That piece requires people to basically be paying for certain things. It's an entry level car. So the predominant factors that would drive the purchase of a car would be the price of the car, the fuel efficiency that a car brings to the table, right? And consequently, the cost of maintenance, right? Not the capex, but also the opex in that context, that, the one-time cost of buying a car and then the cost of maintaining the car all the point of time, part of which is fuel efficiency and part of which is spare parts and all. Maruti was very, very good with this. And because of this, they sort of maintained a very strong dominating market share all this while. Over the past few years, what has changed is basically it started moving towards a little bit more in terms of people have become, there's a slightly better discretionary spending capacity. The features for which people would pay have changed. People now pay for comfort, right? So consequently, the movement towards larger cars in general. People are also paying for security. So a car that has a better security rating now, at least in the past couple of years, you've started seeing uh, is something that people have basically kind of become a bit more. The consumer has become a bit more mindful of that, and they've started looking at that as well. And they're also sort of paying for the fact that you could cover larger distances in that, and that's a function of comfort and security. But yeah, you want something that you can pick up your family in and probably travel around or across two cities, and is still comfortable in that context. And that entire movement has resulted in the movement towards SUVs and MUVs in India. So that's the backdrop or history around this, what has predominantly played out and how it has played out. In terms of India's market and structure, the predominant cars that you see would be Maruti, right? Maruti has about 50% market share approximately. The next biggest one is Hyundai. And Hyundai is also one of those which has had a very good sort of a connect with India's markets. They were very, very strong with the Santro i10, i20s in the compact car segments and then crossovers, and then moved very well with the Creta and Venue and everything that comes beyond that as well. So they've maintained a good market share. I think Hyundai is also about close to, give or take a few, 15% would be this, 50% approximately is this. Maruti has gone down a little bit, but that's the predominant market share that is there. In between, there was a time frame where premium cars that were sort of sold in India were predominantly sedans. And this was a period where Honda was doing very well. So Honda City was basically synonymous with the sedan segment and the premium car segment. But then they sort of lost their stronghold in that segment. Sedan is not a segment that is a very, very predominant segment. In fact, has been declining in India for the past few years. We'll see some data around that as well. The one chart that basically tells us what's really playing out in India's market at this point of time, and importantly, basically looking at what's going on, is this one. So if I were to club hatchbacks and sedans into one component, and I was to club basically, the SUVs and MUVs into one component, and we were to look at the basic market share of these two, in 2014-15, 73, which is 3 out of 4 cars sold in India, 75% approximately, or 3/4 of the cars sold in India were hatchbacks and sedans, predominantly hatchbacks within that. However, now that number has gone to half, 50% each. So SUVs and MUVs have made a massive leap in this period, and hatchbacks and sedans have gone down in that. They've taken the major hit. Predominantly, this was the bread and butter segment for Maruti. So what's interesting is that even though Maruti's market share has remained sort of strong, in fact, increased in some of these segments over this period, other players have moved into other segments, and consequently, there are newer leaders who are emerging in this space, right? Predominantly, the one new leader that you see now in this space is Tata Motors, whose current market share in India's passenger vehicle segment is 13 to 14%. And you also see a good sort of demand for M&M, right? Although there are two ways to kind of go and look at that M&M demand. We'll look at that as we go along. But that's the segment that has sort of picked up significantly, and at the expense of some of the other car makers that are there, and some of it is at the expense of Maruti that we have seen. But that's because the hatchback and sedan volume has kind of gone down a lot. So I'll show you this data, and we'll kind of build on that as we go along. In terms of the data, because this is going to be a predominant factor in our forecast and how do we go about forecasting data there, right? In building any valuation exercise, one of the core points that we need to understand is what is the process we go about doing. right? There are broadly going to be four components to any valuation exercise, right? The first will rely predominantly on your P&L sort of, forecast. Now, this P&L will include your revenue drivers and understanding how do you forecast the revenue, right? This will also include your cost drivers and understand how do you go about looking at the cost forecast. How do you figure out, okay, what kind of cost forecast is going to come up? Then within the balance sheet, there are two separate components that we are looking at. So in the balance sheet, you are basically looking at all the long-term assets and liabilities first. So long-term assets, which is, if you think about it, nothing but your capex plan, capital expenditure. Will you put a new factory, plant, property, machinery, etc.? And you have long-term liabilities that you have to work on. And this predominantly for most companies, whichever company you pick up and model, is going to be your debt schedule, right? And then there are short-term assets and liabilities that are there, which is going to be your entire working capital analysis, right? Which is going to include current assets and current liabilities, right? So that's the third thing. So first is P&L, second is this long-term assets liabilities, third is the working capital, and finally you'll build the cash flows. That's the fourth thing. So there's the fourth parameter in that order as you go along. When you build the cash flow, you will go back and link the cash flow with the balance sheet. So if mechanically you've gone and projected it correctly, then the balance sheet should stay balanced if you've built a dynamic model and put it correctly in terms of your entire exercise. Our purpose is to try and basically reach a stage that we're projecting the next year earnings and we're able to link it well, right? Now, remember, this exercise here is a short exercise. It'll be a fast exercise. So the purview of this may not go into getting into too much depth about each of these elements. Wherever more depth is needed, I will comment on that. So you can take that as an exercise, go and practice. Feel free to add more depth on any of those elements that you're looking at. Some of the things I'll keep telling you in terms of, what are the major relevant points that you will use when you are trying to basically build a model. We'll cover all of these, but some of these may be simpler assumptions as we go along. Wherever more granularity is required, I'll suggest you, and you can go and try that at your own. The principles will remain the same as you go along, right? The that's the idea. So let's, without much ado, jump right into our modeling exercise. Right, let's quickly go to our Excel file. So this is the file that would be available. It will be shared with you, and you can look at the file, and it has broadly four sheets that are put up there. One is the balance sheet, there's P&L, there's assumptions, and there is cash flow statements, right? And our idea would be to basically project the cash flow statements and the balance sheet so that it sort of adds up. And then as required, we'll add more data to this entire sheet as we go along. Let's begin with the understanding of the assumption segment and some data that might be relevant for our purpose. So on top of this, some industry data is available on the assumption sheet. Whenever you're building a model, there are two steps in addition to what we said, which are there. The first is to get the data. Where do you get the data from? The predominant source of gathering data is annual reports. Just rely on annual reports. Do not go to third-party websites trying to capture data. That's not going to be helpful. There are two reasons for this. One, almost all websites make certain adjustments to numbers which you don't want. You want as reported data by the company. Whatever data the company has given, I want that data when I'm trying to build it. If any assumptions have to be made, any changes, adjustments have to be made, I want to do it. I don't want somebody else to be doing it for me. That's part one. Part two, when you punch in the data yourself, you will realize and start spotting things about the company that would be relevant. For example, when in the process of putting this data in, you will realize that, oh, look, Maruti's sales are close to 80 to 90,000 crore. That's a big number, right? And you can actually back calculate from there and say, okay, if 80 to 90,000 crore is the is the sales number, and approximately 5 lakh rupees per car is what Maruti is charging, then they must be selling probably 16 to 18 lakh cars a year, right? You can back calculate it once you are punching this data in. When you are punching this data in, you'll also realize immediately that your biggest cost here is the cost of raw materials, right? Basically stuff they are purchasing, putting in the car, and sort of basically selling it. That's your biggest cost that is going to be there. When you put this data, you'll realize there's very little finance cost. The company does not have borrowings, right? You'll realize that in terms of their investments, they have a large chunk of investments which are available here. And you will also see that in terms of their liabilities side, if you look at the liabilities, there are very little borrowings on the short term space and very little borrowings on the long term side as well. So predominantly not a very uh, sort of debt intensive industry. It's a fairly straightforward business that you see. When you punch in these numbers, you will realize that the balance sheet size, if you look at total assets for the company, is close to about 75,000 crore. But the fixed assets within that is a small component. The fixed asset number is about 15,000 crore, tangible, intangible, and capital work in progress put together. So it is not a capital intensive business. With a net fixed asset value of 15,000 crore, you can generate 90,000 crore of sales, right? If you go and check this for, let's say, an Airtel, for example, you'll realize what do you mean by a capital intensive business? How much asset do you need in order to go and generate a rupee of sales? Here, this is not a very big component. So this is predominantly a business that is running without debt, cash generating business, makes reasonable margins, makes reasonable money. You will realize a lot of these points when you are punching in numbers on your own. So I'm a strong proponent of doing this on your own. The first time you do it, it appears like a very sort of time consuming exercise and you feel like, why am I doing it? Right? Is there a shortcut to this? But you do it 3, 4 times. Trust me on this, that you will generate significant speed on it, right? You'll be able to put in 4, 5 years of data for a particular company in about half an hour to 45 minutes, looking from annual reports. And the sort of understanding and insights you develop while doing that exercise is unparalleled. If I was to withdraw this data from a third party source, I will have no clue till the time I actually look and try and sort of understand the numbers on my own, right? So preferably go to the annual reports, pick the data from there, punch in from there. That's what we have done. We've put in this data here for us. Then you get to industry data, which is available scattered across variety of sources. You might find it in some industry bodies. You might find it in some news items. You might find it in annual reports of companies. You'll have to dig that and populate this. The first part is gathering the data. The second part is the brain of your model, which is going to be this assumption sheet, right? That's where all your calculations will basically come up. That's where your working will work and come up, and that's what you're going to try and project here, right? Now we have some data for India's data with respect to the segments that exist. You have hatchbacks, you have sedans, you have SUVs, you have MUVs, and you have this data, and you'll see India in the last year has sold 30 lakh cars. This is in lakhs. A couple of years back, till pre-corona, we used to sell close to 33, almost touching 34 lakhs. And then we had a couple of tough years. Financial year 2020 was tough because of the BS4 regulations that kind of came in, and you had to kind of change the platforms that were there. And 2021 was impacted by corona, so obviously there was an impact that came because of that. 22 sort of revival, but the first quarter was still hit. 23 is the first full year that is coming after all these years. So 23 is what you will compare with predominantly 2019 now when you get data around 23, right? That's the construct you're looking at. Let's very quickly calculate growth rates for this. So I will just basically calculate the growth rate data and look at the growth rate across these segments. You will realize the points to be noted are significant decline in sedan volume in India. You used to sell 6 lakh vehicles in 2019. That's become 3 lakh now, and massive absolute terms 3 lakh decline, and equivalent 3 lakh decline in absolute terms, although in percentage terms it doesn't appear to be as large on the hatchback segment. Hatchbacks, which used to be 15, 16 lakh almost, have now gone to 12 lakhs again. And that's been the issue with Maruti in terms of the scale that has come up. The significant growth has been picked up in the SUV segment. You will note SUV segment has basically neither did it decline in those initial years, and then it started growing significantly. And this is what some of your newer players have basically captured, the space that has been captured. That's what ratios we were calculating. What used to be predominantly 21, 22 lakhs of hatchback and sedan and only about 11 lakhs of SUV, MUV has then moved to 15 and 15 now. And looks like this trend is likely to stay for the reasons we just talked about, right? In terms of the affordability and the fact that people are paying for comfort, long distance riding, and security as a feature. That's probably a trend that is likely to stay, right? You look at some more data in terms of the capacity. So Maruti has given this capacity across various reports. Again, you can capture it and put it there. Then we have Maruti's domestic sales data, which is how much have they sold in India, how much have they sold in export terms, right? And again, I can calculate the growth rates in this data. So let's do that. And we have these growth rates. You will note that the domestic volumes have declined. Exports have done well in the last year. So it seems Maruti is clearly focusing on the export segment till the time the domestic segment sort of picks up. And that's been the strategy that has played out in this overall context that you're looking at. In terms of their market share, domestic market share, if I look at, I'm seeing that market share decline for now 2 to 3 years. Used to be 52%, 52%, 50, now 46. And in recent months, this is running at about 42 to 44% because Tata Motors has been gaining a lot of that market share domestically, right? Let's move to our key revenue drivers. Now, for revenue drivers in this case, how do I project revenue? One common method of revenue projection that a lot of people take is basically in terms of trying to go ahead and assume a forecast growth rate based on historical growth rates. The problem with that approach that I keep saying on across a lot of platforms is for that, a company that is growing will always keep growing, and a company that is not growing will never grow if you use those assumptions. So that doesn't work well. You have to go one layer deeper, at least, if not more granularity of data to be able to figure out, okay, what kind of numbers you're looking at. Now, all this data is available in public sources and annual reports. You'll have to dig a little bit deeper and collate it over a period of time. But with some effort, you will find a lot of this data that is available. Sometimes you might see some broking report that is covering it, and that could also give you some of this data that is available. So whenever you come across the data, keep a note of it. It might be useful for some companies' analysis at a later point of time. If I break this problem down into how do I project revenue for this company in the future, my revenue projection is predominantly going to be a function of volume sold and what is the price per unit, right? If I just go and project revenue and tomorrow I go wrong on it, next year, some other number, I project revenue 88,000 crore becomes like 95,000 crore next year, right? Make an assumption of 10% growth or something of that sort. If this number goes wrong, right? If this number goes wrong, the problem with that is I don't know where I went wrong, right? If I can break it down into sort of volume and realizations, then I will at least have one more layer of understanding that when, look, I went wrong on volumes or I went wrong on realizations, right? So we'll break that down. Let's try and find this out. Remember, this number is in INR crore. The volume we have is in lakhs. So I'll convert this to lakhs first. How do I do that? This into 100. And then I divide it by the volume of vehicles sold by Maruti, which is 17.8 lakhs total volume, right? Because export will give you an income. So I'll get the realization roughly about 4.5 to 5 lakhs per vehicle is what Maruti has been seeing. I can quickly look at realization growth as well. So that's this upon this. Sorry, made a mistake. 37 divided by 37 minus 1. And the volume has sort of moved, but more importantly, realization has moved. Now, the realization going up could be a function of a variety of things. Part of it is inflationary in nature. Most likely, inflation would have played out as well, right? If you see last 2 years, for example, volume has gone up from 14 to 16.5. Realizations have gone up. Part of it is inflationary in nature. Part of it is also because you're exporting more. So maybe your realizations are slightly better on exports and consequently that has played out. Uh, Premiumization is the third case, which is your product mix is moving probably a little bit more towards SUVs and MUVs in general. And that is also causing the realization bit to kind of go up, right? So that gives us the realization data. That's our revenue now number per vehicle that is available. Now, next year, I can project what is going to be Maruti's sales volume based on some market share assumptions and some assumptions around export volume, right? So I'll make two assumptions now. One assumption would be on what do I think will be export growth rates, and the second assumption would be what would be domestic sort of market share for Maruti. And the third assumption I have to take is what will the market grow by, right? How much will the total sales in India's market grow by? When I look at this and then calculate it, I will be able to arrive at, okay, this should be a ballpark sales number. Now, we are not sitting here to dissect whether or not that number is correct. I leave that judgment up to you. My number is not something you have to agree with, right? I'm just putting this as a process. We may need more research to come up with the exact data, right? But the flow of the model and the process will be similar. Let's say I assume that sales will increase by 10% in India in this pent-up demand, economy opening up, a lot of things, which means total vehicle sales would be equivalent to this much, 33.75, correct? Let's just format this the same way. And let's just, oops, let's just put italics here, right? So we know it's a growth number. I have to assume what kind of growth number will be with respect to exports. Let's assume a simple 20% number. It's a small base at this point of time. We can also go and look at what data is available for the first 6 months and try and predominantly apply this. So this is going to be the exports volume for the company, right? And we get that. We have to assume the domestic market share as well. We know that at this point of time, they're running around 42 to 44%, assuming they're able to sort of maintain it at 44. I'm saying that my domestic volume is going to be 44% of whatever is my domestic passenger vehicles data. This is domestic sales in India, not exports. So I get that, which gives me a total vehicle sales of 17.7 lakhs for the financial year 2023. There are assumptions that have gone in. As I said, you do not need to agree with these assumptions. The process remains the same. Feel free to go and basically change these assumptions when you try and do the model at your own. Just play around with the numbers, see what you get, right? Then I have to make an assumption on realizations growth. Again, I'll just highlight this that it's a growth number and it's an assumption. So I'm going to highlight wherever there is an assumption. I'm shading that in a different color so that I know that these are the cells that have to be changed. Everything else is going to get linked through to a formula to this, right? Let's assume that the inflation continues and the upward journey in terms of premiumization continues. They're selling more, Brezas and Vitara, Grand Vitaras that they're doing. So assume 10%. This is a combination of inflation and product upgrade that is happening. So once again, this into 1 plus 10% gives me the data. That's my unit per unit pricing. If this is my per unit pricing, and I know the vehicles are available in lakhs, 17.7, this will give me data in lakhs. I have to divide by 100 to get the data in crores, right? So 1 lakh crore is going to be the sales for Maruti. That's what we have projected for the following year, right? As I said, these numbers are not foolproof. The process remains similar. If you want to go one step granular, you can find out the breakup of how many hatchbacks plus sedans they sell, how much SUV and MUV they sell, and then put a number there. The only problem is they don't give you the realizations category wise. So then you have to dig a little bit deeper, do more research around it, and then come up and say, okay, these many SUVs, these many sedans, or these many hatchbacks, and consequently the combination gives you a certain data. Doable, just requires more granularity. We are not looking at that granularity here, right? Next, we go to RM costs. RM cost is a combination on your P&L statement, the combination of cost of materials, purchase of stock in trade, and changes to inventory. Add all these three. These three added together is 54,000. So I'll find out RM cost because this will depend on vehicles sold. So RM cost converted into lakhs divided by total number of vehicles sold, right? It's a straight combination or factor of what is my vehicle cost. You will realize that the jump in selling price, which was 11%, was more on account of trying to manage their margins because their cost went up. Realize your cost per vehicle went up. RM cost per vehicle went up 15%. And that's been growing all these years, right? 3%, 5%. So inflation adjusted, this year was a bigger spike because metal prices went up, right? In FY22. And that sort of basically played up. That predominantly is why, because steel goes in manufacturing of vehicles, steel prices go up, and that's why India put an export duty on steel. So you can link all of this spectrum together because the automakers would have basically gone and said that, look, steel prices have gone really high. Please do something about it, right? Then there are employee costs and other expenses. Employee cost, I'm just taking simple as a percentage of sales. You could take it on a capacity basis as well if you want. But to keep things simple, I'm just going to predict it or project it based on sales. Gone up, two reasons. Again, inflation. And second, their sales have been stagnant for 4 years. You wouldn't be able to keep salaries stagnant. Although it's not a very big cost for them. If you sell 100 rupees worth of vehicles, their cost is about 4.5 rupees there. Other expenses per vehicle sold. Once again, I will try and calculate this in terms of INR. So that's my other expenses into 100, converting it to lakhs and dividing it by the vehicle numbers. So that basically puts me about 50,000 going all the way up to 76,000. This has gone up. Acha, one thing that you want to kind of do if you are going again granular a little bit more, other expenses per vehicle includes a royalty component that Maruti basically pays to Suzuki. That is a straight component of your revenue value number. I think 4% of revenue or something of that sort is there. You can try and segregate this, take the royalty component out of other expenses, and then remaining other expenses could be projected on a per car basis. For simplicity and paucity of time, I have not done that. If you want, you could break up this into two components, royalty and other expenses. Royalty will be fixed as a percentage of sales value. Other expenses would be as a percentage of sales volume. We have taken volume here. We can see what kind of growth has happened there. Once again, has continued to go up, but this is an expense they've maintained in the last 2-3 years. Their predominant hit was, I think, 2020, but post that it has sort of stayed sort of in line. They haven't really increased this significantly. Now, if I have to basically project it in terms of subsequent years, I have to make three assumptions. Assumption one, how much will my raw material cost per vehicle grow by? Assumption two, what is going to be employee cost as a percentage of sales? Assumption three, what is the growth rate in other expenses per vehicle? So I'll take simple numbers. This is going to be inflation adjusted. Because I've assumed a price rise there, I'm going to keep this at 6% inflation as well. And for the time being, because sales are going to go up, I will assume a simple, and you can corroborate some of this with the exact volume data at this point of time in the market. You'll realize the first few months they've done better than last year in terms of the volumes. So sales revenue will go up. As revenue goes up, your volume as a percentage, your employee cost as a percentage of sales need not go up, right? Ideal word, if you have the data that is available, you want to fix the employee cost on a per vehicle capacity or per lakh vehicle capacity. You could do that analysis as well, saying if my vehicle capacity is X, there is a cost. If it changes to X into 20% higher, then the cost will change then when I add capacity, right? You could do that as well. I'm just giving you ideas that how can you model it in separate ways, whichever you think is the best way in your opinion, you can use that, right? So I'm going to assume this will go down to, let's say, 4.5%. If I have this, I can assume a growth rate, and this number will be a growth number. Similarly, this would be a growth number. Both these numbers have been calculated. And based on this, I can say, okay, 4,23,000 per car. How many cars sold? 17.7 divided by 100 to convert it to crores. That's my raw material cost. Employee cost, I'll format it in a minute. Employee cost is 4.5 into my revenue, which is this. So that's done there. And other expenses is 79 into 17.7 lakh cars divided by 100, converted to crores again. So that's my data formatted. One thing I again reiterate a lot of the times when I see models or look at people working on models, a very simple thing to follow in financial modeling is keep the model hygiene, right? Which means decimal point shouldn't be all scattered around. If you're using one decimal, use one decimal across all numbers. If you're using no decimals, use no decimals across all numbers. Percentages you can probably skip if you want to go granular. For example, sometimes here I don't need a decimal point, but here I'm using. But wherever you are using numbers, please try and keep numbers with a single thought process, either one decimal point or no decimal point. We're using no decimal points here in numbers, right? That's the data. That's my PNL. So I've basically projected the PNL for next year. If I want, I can quickly go and populate this data here. So my revenue from operations is available. That's about 1 lakh crore, right? Other income we'll not project. If required, we can keep it the same as last year. Ignore that. This is a sum of these two. So I get the number here. In fact, what I can do is I can select this entire thing, format this and put a format here. That'll be easier for us, right? So that brings us to this number. These three will get combined now. So I'm just using one number instead of these three, which is my raw material cost. That's 75, right? Then I go to employee benefit expenses. I link that, which is 4685. I go to other expenses and I link that to the assumption sheet. That is 14123. These are linked. Depreciation is left, which will come once we do depreciation analysis or fixed asset analysis. Interest cost or finance cost, this is more likely because there was some flow of sort of finance cost during the year. We're not really thinking that they're going to use this. So, whatever is there is there. I'm going to keep this constant. It's a small number. I'll not break my head too much over it. Same with vehicles, etc. for own die usage. Use the same dies for own use. Keep it there, right? Everything else, keep it constant. Whichever is a small number, don't worry too much about it. The data points are here. Tax number is something you want to project. So I'll keep this simple. I'll keep a simple tax rate or effective tax rate that is going to play out. I can also calculate what is the effective sort of tax rate here. How do I do that? What is the total tax number? That's the sum of these two, current and deferred tax. Acha, sitting outside with public data, you can't go about working on deferred tax. So just assume what is the total tax? That's the sum of these two. It's here, right? And this is on profit before tax. So that's my effective tax rate. You'll realize that has moved around. Last couple of years, they may have probably booked some the deferred tax has been different, which has caused the change. Going ahead, however, for our understanding, deferred tax is just a timing issue in terms of tax looking at. So I'm going to make a simple assumption. This is going to remain 25%, which is the corporate tax rate, right? So if that is the case, my total tax is basically PBT into 25%, which basically gives me the profit and loss number. There is one data point which is missing. That data point is basically my depreciation data point. That's a large number. We will put that number once we have done the capex assumptions in a few minutes from now. So far, so good. So my PNL is more or less linked. Once again, I'll reiterate, we've used a process to come to this number, but we don't know if all the assumptions we've made are exactly correct. It is beyond the scope in this particular session to try and go and dig deeper into each of those assumptions that we've put in. Please feel free to go and look at those assumptions and change those numbers when you want. As I said, I'm more focused about how do we go about building a valuation model here, right? That's one part of it. That's done. Now we move to our assumptions around, let's say, long-term assets, long-term liabilities, and current assets and current liabilities. Let's first do current asset, current liabilities. I've put in all the current assets and current liabilities numbers here, picked up from the balance sheet. Let's calculate everything as a percentage of sales. Generally, working capital is denoted in terms of either sales, days sales notation, right? Or you can use it as a percentage of sales. Usually companies try to keep them consistent as a percentage of sales. So I'm going to basically do that, freeze the sales number row, not the column. That's a percentage data. I can drag it till here. You'll note inventory is like fairly consistent, 4% of sales almost all the time, right? And just drag it down. Basically everything is available here. And these are all cells I have to basically remove, right? So look at the ones which are like large. That's basically something you want to project. Everything else just sort of focus on keeping where it is. In terms of your assets, you'll realize I've picked up this data from here. So some of them are going to be blank cells, like financial assets is blank. It's giving you investments. I think we don't need investments. We'll treat investments, short-term investments, as cash equivalents. So I'm actually going to delete this data here, not relevant. We are going to keep this constant or add this last data 4100 into the PNL, into the cash balances. So just delete these two, not needed. On the liabilities side, things are fine. So we get some amount of data that is there. Good enough. This is good, right? Now that we have this, I can make a projection for next year. What are these numbers going to be as a percentage of sales? Effectively, what you are looking at is a bunch of data points that are going to play out. Okay, I've missed out something. Let's look at this. Let's look at this. Why does this number look odd? That's because it is connecting with payables. Okay, so I've missed out something here. There's slight linkage issue. Let's see, inventory connects with this next to our zero. This is linking with this correctly. Where is borrowings linking at? So borrowings has to link here. There's an extra row that is available there, and that was causing the problem. Let's dig it down. Now we have the correct data. Yeah, seems to be correct. Payables are like 10% of sales approximately. Inventory is like 4%. There is no real receivable. Receivable is at 2% or something of that sort. It's not a very heavy working capital business. I mean, if you actually were to calculate, and let me just introduce a couple of rows here and say working capital. My working capital in INR crore is nothing but the sum of all of these current assets, right? Minus the sum of all of these current liabilities, correct? Negative working capital business, right? Brilliant. So great business. There's no working capital. Why should working capital be negative? If you want to kind of look at that, you can go and check. There's another video of ours on YouTube that would help you out with that. Should working capital be positive or negative? Last year, 2021, you can understand they were not able to make payables go out. So there was sort of a, payables piled up, probably because time was not good. So that was 1 year that kind of worked. But then, they've taken payables back to the historical averages, and that's why you see a slight jump. My sense is these are numbers which are small. You don't need to worry too much about them again. And so there are two ways to go about it. If you can spot a very clear trend, like a very steady, stable sort of a number, take an average. Simple, not too difficult, right? And just sort of put it down. There's one, like other financial assets as a percentage of sales, that seems to be going up. You want to be careful with this. So maybe I'll keep this constant at last year's number. Everything else, I've just taken an average and sort of put it there. Same for the averages here. I can take the averages for most of them. Generally, the company seems to be maintaining that. Once again, just check trends. If you see something going up, for example, other financial liabilities has also kind of gone up. So I again keep this in trend, same as this, right? Once I've made these assumptions, remember these are percentage of sales. Once again, as I said, this is a process. I'm trying to kind of put things in place. You don't need to agree with the numbers here. We do not have enough time here to kind of go and dig into each one of them and look at exactly what should be the number. If you want to dig deeper, try and find out how much should be inventory, is there anything about inventory, and then put that number there. That's your choice. I'll leave that up to you. Now that we have a percentage of assets that are defined as a percentage of sales, so basically my calculation is revenue into this number, whatever is the percentage, right? And function F4, and the row has to, sorry, I have to freeze the revenue number. I froze the wrong number here. H36 is to be the one which is to be frozen, right? So that's done. That's my inventories because revenue has gone up. So I do this. And just to avoid that problem that happened earlier, I will link it again now with this 0.3 multiplied by my revenue number, which is here. And freeze the revenue number, drag it down. Voila. So that does this calculation. Is done. I can drag it ahead. Working capital projections done. I've taken care of working capital as well, right? That freezes this bit. The long-term assets, long-term liabilities is what comes next. Long-term liabilities for this company is no change. There's no debt. So we leave it where it is. We don't need a debt schedule. Long-term assets is what we need. That's what we are going to look at. Now, when you do CapEx, the CapEx could be on two parts. One is you're adding capacity. So you'll do some CapEx there. The second could be you're basically sort of doing CapEx, but you are doing it for wear and tear. Right now, generally what tends to happen is if you're not adding capacity, you will do wear and tear capex, which is similar to, in a way, last year's depreciation is your wear and tear this year, right? So I can basically just link this wear and tear capex number here and look at their capacity at this point of time. Their capacity is about 22.5 lakh vehicles. They're selling like 16, 17. There's no real need to do this. It doesn't take too much time to add a lot of capacity in autos. So I'll not assume any new capacity addition here. That's my total capex. I have to assume these. So what I'll do is I'll put these as shaded cells. So we know these are assumptions, right? So that's an assumption. I also check what is my depreciation as a percentage of net fixed assets last year, right? And I see that it's been about, sort of 20 to 23%. Last 2 years has been 20. So I'll fix it at 20 and keep it here. This is net fixed assets last year, which means I'm assuming written down value. You can also go and do a straight line method, but for that you will need gross fixed assets, which are not available here. The gross value of fixed assets would be available in the annual report. You can go and dig into the annual report, put that data there and create a CapEx schedule. That's also possible. The depreciation number itself should not impact your valuation too much. Why shouldn't it impact your valuation too much? You're doing a DCF valuation. DCF is discounted cash flows. Cash flows don't get impacted by depreciation. The only impact of the depreciation is if instead of 100, I take 120, that 20 will have a tax impact over a certain time frame. It's a time issue. Again, it'll come at a later point. Other than that, I'm anyway going to add depreciation back because I'm going to add it back in my cash flows. I don't break my head too much over it, right? So 20% into my balance sheet data about last year's tangible and intangible assets. That gives me the depreciation for this year, correct? So that's data about depreciation. Now my fixed assets, you will note, is going to be adding this much and subtracting this much. So that's the net movement in my fixed asset value over the year if I'm not doing any capex that is there. And rest of it is sort of straightforward. This is available. I can now go and put all of this in my balance sheet. So let's assume that I'm going to keep things simple and I will just add all of these line items, which is capital work in progress, will go and sit here, and intangible assets under development and capex, right? And remember, when I do capex, that is this minus, remember, this is the depreciated value. So I have to remove the depreciation, net fixed assets, right? So that's my value, which is equivalent to these four put together. I just added all four of them there. I can also do it directly here and then keep these three constant. That's also one way to do it, right? So that's another way I can do it. But what I've done is basically converted all these to zero. Sorry, this will be the same. Right of use assets is something new that has come up post the change in lease accounting, where operating leases have to be converted to financial leases. Don't worry too much about it. If you're doing this as an exercise, this is a simple, for a company that has a small number there, you don't need to worry, just keep it constant. Don't worry about it, right? Investments, these must be liquid investments that can be used or investments that the company would have done in some subsidiary. I'll keep it where it is. All other numbers that you have no way of projecting or are small as a percentage of your overall balance sheet, keep them where they are, right? So that gives me my total non-current assets data. These I have projected. So these are on the assumption sheet. Where's my inventory data? I just have to be a little bit careful here because I've deleted a couple of rows in between. So till trade receivable is fine, but then cash and bank balances I have not kept there. So I'll go there and assumptions, I will link to loans, right? That's my loans number 23 all the way down till here, right? What we'll also do is I'll select this entire column all the way up to here. Let's do a format paint and let's do that here as well, so that I don't have to again and again do the decimal changes that are happening. It's all there. Now that it is here, I can drag these. That's the data that is available, correct? Share capital remains the same, right? Other equity, reserves and surplus. So this plus the profit for the year. Where's my profit? That's this one. This will change, by the way, because we'll add the depreciation number. Others are sort of constant. I just copy and paste the formula there. These are all small numbers, so I'm going to link everything to last year, which means this would be the same as last year. Borrowings and all I have projected, so these are all on my assumption sheet. Let's put it here and drag it down all the way up to here. So we have all the data, we have all the current liabilities, total liabilities, everything is put up. I should add a cell called check. Check is total liabilities minus total assets. So last year's number should be 0. The year before that should be 0, and so on and so forth. But this year there is a gap that we'll get. This is because we have not yet put in the cash flow data. Once we punch in the cash flow data, that should match. Two quick adjustments to be done. One is essentially my depreciation and amortization expense has to be linked from the assumption sheet. I would have projected it for this year, 2635. That comes here. Profit goes down to that extent and that amount, right? And now I will populate the cash flow statement. When I start the cash flow statement, my opening cash for the year. So let's look at the opening cash or closing cash for the previous year. On my P&L, on my balance sheet, if you see, I have this cash and bank balances, cash and cash equivalents and bank balances. I've combined them. Also, remember this investments, I have made 0, right? So this would be in the subsequent year. So 4100 plus 35 plus 3007, right? I'll again show this to you once again on the P&L, on the balance sheet, sorry. I have basically selected these three numbers into my closing cash. I've combined these three, which means this will become 0. This will become 0. The final balancing figure will be in cash and cash equivalents. That is going to come and sit there. Correct? Now we can populate the cash flow statement. Closing balance for last year is here. That's this, right? On the balance sheet. Let's quickly look at this. On the cash flow statement, I will add what is net profit. So that's here. Add my depreciation from the P&L statement. That is here. Look at changes to net working capital. That's on the assumption sheet. That is here. Look at CapEx. Where's my CapEx on the assumption sheet? This is my CapEx. Look at changes to debt. That's 0. Changes to equity. That's 0. What's my cash flow? Net profit plus depreciation minus change to working capital minus CapEx plus any changes to debt plus any changes to equity, right? Add these two. What do we get? 15319. This 15319 has to get linked in my cash and bank balances portion. If this links correctly and my balance sheet balances, then basically I have a fully linked dynamic model. I have put everything correctly. There's no hard coded pieces anywhere. All I need to do is change the sort of value a little bit here or there in terms of the assumptions, and it should still stay balanced, right? So let's link it. Once I've linked this, let's go and check. Yep, balances. So now we have a fully balanced balance sheet that is available. If I want to basically go about doing a valuation of this exercise, all I need to do is extend this for subsequent years, right? If I extend this for subsequent years, given that this is a balanced balance sheet at this point of time, it should stay balanced even from here onwards, right? So that's the first part of our exercise that we were to do, which is basically create a process and link everything together in a model. This is how you go about building something from scratch in terms of collating all the data and arriving at a completely balanced balance sheet. The next set of tasks is essentially I can just, select all of this here. And ideally, if I've done this correctly, I can copy and paste this, let's say for the next 4 years. I will do the same for the PNL, which will all be zero for the time being because we have not projected the data with respect to the assumption sheet. So all my numbers on the data will look odd. Let's go to the assumption sheet. I can copy this entire set because if I've linked it correctly, then all my formulas should match and they should sort of keep going, right? So 4 years done here as well, right? 2026, 2027, right? And maybe the growth rate of the markets I want to change to this number. And maybe I want to kind of say that the market share will also start declining a little bit and my export growth rates will slow down, right? So, or I can say that they'll focus more on exports and exports will continue to go up, but market share might slowly keep declining by, let's say, 1% point over this period. So they're here. They may not need any capex in that context because they're already sitting with the capacity. If they need, that's not too difficult. I can just model it here. Some capex has to come somewhere here. And consequently, my balance sheet, you'll see, will not be balancing at this point. But if I was doing it correctly, then all I need to do is keep doing this for the next 4 years. And ideally, at this stage, let's check, it should balance, right? So the model is ready, completely linked. Now comes the real part around it, which is basically you have to make assumptions and check whether your assumptions pass the test. This is the relatively simple part around it, right? The building the model. Now you have to go and dig deeper into each of these numbers, and there's endless amount of research you can do. People do this for years after years to figure out what should be the growth rate of the car sales in India next year, right? And it takes time for you to really understand what is going on. So I'm not going to touch that here, but that's basically one of the core steps that follows. And then once you have this cash flow statement, you will go about doing a discounted cash flow where you will need a discount rate, where you will need a how do you go about calculating a discount rate? Again, lots of theory there, but broadly, some discount rate has to be coming up. You have to discount this, you have to discount what's going to happen in future after this, and you have to arrive at what is going to be the value of the company, right? So that, in a nutshell, is our first part of the valuation modeling exercise of Maruti.